Hi, I'm Stephanie, an advisor here at Generate KiwiSaver, and this is Ayrton Oliver, one of our portfolio investment managers. Welcome, Ayrton.
Good morning.
So it appears like the outlook has shifted globally. What's happening in macroeconomic?
Yeah, so the outlook's shifted a bit recently with some incoming data. So in the US especially, you're getting more fears of a recession. So previously there was, I guess, less fears that things were slowing down and everyone's kind of ticking along okay. But data is coming in at the moment and giving a bit more fears of recession, which is slowing down equity moves and causing rates to move lower.
So previously the US had talked of a soft landing. What's changed?
Yeah, so with a soft landing, that was the idea that we could bring inflation down without crashing the market and without getting a massive increase in unemployment. Unfortunately, that's starting to shift. So we've got some recent data, especially on the employment side, coming in with jobless claims going up. So unemployment went up in the US, albeit only from 4.1 to 4.3%. So it's not a huge number. It's not a massive amount of unemployment that we saw during like GFC. Also in some of these surveys we've got with hiring intentions from managers slowing down hiring intentions. So pulling back on hiring plans, pulling back on headcount, and that's giving a bit of worry to the market that once the employment picture slows down, then people will stop spending, and because it's the main thing that's holding it up right now is everyone's got a job.
Yeah.
So that's got some worries that will slow the US growth down and give us a recession. There are some indicators that suggest that when employment changes at this pace, that a recession is imminent. So we'll see if that materialises, and that's caused some volatility in stock markets.
Last time we spoke, Australia was the outlier. Has this continued?
No, so Australia has come back into line, as you could say. So yeah, a couple of months ago, Australian CPI inflation was higher. It went up when everyone else is going down. So that gave people quite a bit of worry that the RBA would have to hike again to continue to get inflation under control. This changed. So last week, inflation was lower than expected. So it kind of took that worry off. Now we've taken out any aspect of hikes from the RBA, and now they're back into line with cuts coming soon. But they're probably going to be a bit later, so they'll probably be on hold for longer. Their rates were lower, their cash rates, so they can probably hold rates at the same level for longer. But yeah, it doesn't look like they'll need to be hiking.
Perfect. It's great for the home buyers. So in general, data is driving central banks to cut rates.
It is. So we, had to hike rates to get inflation under control over the last 2 years. So all central banks were in a rush to hike rates to get inflation back down. Now everyone's kind of waiting to see when central banks can cut rates back to normal levels. So we're currently at restrictive monetary policy levels, which restricts the economy, restricts inflation, and hurts household spending. We're looking to bring that back down to different rates across the world, but all less restrictive than they are now. So the Bank of England has already cut. That was a 5-4 vote, so they're on the fence, but most of them were worried about the outlook. So they're starting to get people and central bankers worried about the outlook for the economy, worried about employment, and comfortable that inflation's low enough to cut rates. And so that's feeding through into the rest of the world. The US is looking to cut rates probably in September. The market, being more worried, is saying they should cut more. They probably think they should have cut last week, but we'll likely see some cuts by the end of the year in the US and then potentially in New Zealand as well.
So how about back home in New Zealand?
Yeah, so I think if you listened to me the last time and probably all year, I've been pretty pessimistic on the New Zealand economy. We were one of the first to hike, and quite aggressively. As anyone with a mortgage will know, it's been pretty painful, and that's starting to work. So inflation has come down. I think the worry for the central bank here is that the economy is slowing more than they probably expected, and anecdotally, you're seeing job losses or slowing in hiring and people not spending as much money, and the housing market really is struggling. So the central bank is now looking to cut. The market's expecting them to be able to cut potentially next week. I'm not that sure if they'll cut next week, given their mandate is inflation, and inflation still is not back in the 1 to 3% range. But they would definitely be cutting by the end of the year, probably multiple times. And so that should give some support to the New Zealand economy, but I think it's a little bit, we've put a lot of pain into the New Zealand economy to get inflation down, and it will take some time to bounce back. But there are lags, and it will take a while for people to realise these new rates and have more disposable income.
Yeah, for the effect on everyone.
Yeah.
How have you been positioning the fixed income fund and portfolios in general?
Yeah, so for the fixed income fund, given my view on rates going lower as inflation comes down and the economy's slow, I've been longer duration, so it means I make better returns or outperform when rates go lower, so that's worked very well. And then inside the portfolios in general, we had been becoming quite concerned about the outlook for global economies, and so been de-weighting or underweighting our asset allocation to growth over the last couple of weeks or months. So that's kind of positioning for the slowdown to somewhat, and putting more money into fixed income. So trying to allocate away from things that might have a bit of a hard time when things slow, and into things that will perform better when interest rates come lower.
Thank you, Ayrton.
You're welcome.
Thanks for watching.